What's up, everyone? I'm Nick Campo. This is
Big Boss Ben.
Big Boss Ben, and we are
the Lone Guys Podcast.
We have an absolutely awesome episode for you this week. We're going to start out the FHFA admits they screw up, get rid of DTI, LLPA adjustments. We have a little bit of information on one of our lending partners who we thought was trying to steal our client, but stay tuned for that. What else are we talking about? Are we going to talk about how good-looking Janet Yellen is? Maybe we'll get into that. We also have somebody trying to steal our employees, and much, much more. Ben, you have a few surprises for me on this episode as well, huh?
I do.
So what should we start with?
So let's start with the LLPAs, the loan level pricing adjustments. So the FHFA, this is about a week and a half ago, as of this recording now, had decided to adjust them again. And they're actually having a House meeting at the U.S. Congress to discuss the new adjustments to the LLPAs and if they are legal or not.
Are they legal?
I mean, yes, they have every right to make the changes. However, the discussion is, hey, are they getting too involved into politics? Like, the whole reason for these LLPAs are to balance secondary market, balance adjusted risks. Mm-hmm. That are associated with the loan in different buckets. So, I mean, you have different credit score buckets, different LTV buckets. They are not going to be able to get to know every single client like we do as a broker. So what they do on the secondary market is they put you in these different buckets, and that's why people have different rates. There's a different cost for your rate depending on all the criteria. What they've now done is they decided to remove the debt to income ratios from that completely. The reason being is because a lot of people were getting quoted a price that would change after their income was actually looked at and verified.
Hold on. Let's talk a little bit about that. So They were getting quoted the price up front,
yes,
mostly by retail lenders, credit unions, or banks, or the builder's lender.
Right.
And then it would change once you got into process, almost like a bait and switch.
I mean, pretty much so, because they were just going off an application, going off of what someone thought they made without any knowledge of any sort of what underwriting guidelines and what you actually have to treat the income with.
But us here at NBI Financial Group, we don't do that. Right. Even when the DTI was on there, we would quote them their actual rate. And we would run into this all the time, and they would be like, well, how come I got this rate here? Look at this loan estimate. And we're like, because it's not a real rate, and that's also not a real loan estimate most of the time.
Right.
So yeah, I'm happy that they're going away from that because now everyone's on the even playing field.
Yeah.
Like, they can't lie. Well, I'm sure they'll figure out another way to lie. They'll probably just not put their closing costs in correctly like most banks, credit unions, and retail mortgage lenders have done that I've competed against. Yeah, so anyways, keep going. Sorry.
No. I mean, it brings up a good question, though, is are these changes made because of politics, or are they made because of the market? Because I don't understand. Like, it does not make any sense of why you would lower the risk. Like, are you saying that there's an increased risk for a higher credit score client in this market? Or are they doing it for political reasons to kind of help prevent people from the more slow down buyers? Are they kind of getting their own version of the Fed to try to help stop inflation?
I think that you and I will disagree on this.
Okay.
And I think that's a good thing, because I don't want the audience to think that, that you copy everything I do. So, here's the deal. I think that we're in an environment where we believe in home ownership, right?
We do.
Home ownership, I believe in it. It's, if you don't have a primary residence, figure out how to get into a primary residence. I also believe in free market capitalism, which we have not been a free market capitalist country in a long time. The markets are influenced. We're a mixed economy now. I do think there's elements of capitalism, but it's not pure capitalism, right? Pure capitalism is barter system. And this is where it's kind of conflicting to me, but I also have a soft spot for people, unlike what TikTok thinks. So I think that the LLPA adjustments are okay in today's environment. And I'm actually going to look on the positive side and the rosy side and the bright side of it and say it's not politically motivated. What I think it is we're trying to get a control on inflation, one. But I think the other piece is there's a massive inventory issue.
Yes.
And I think that, and I know that you have to, if there's an inventory issue, if you want inflation to go down, you need the price of properties to stop rising. Correct?
Correct.
And when there's a low supply and a high demand, prices are going to go up. And if interest rates were low and money was easy to borrow still, or cheap to borrow still, you're telling me there's not a lot of 800 plus FICO people who would borrow that cheap money, buy a property, and then rent it out, and then they're now competing with the primary, right? They're competing with the person who wants the second home, and they're just driving prices up because of this inventory issue we have. I also believe that FHFA wants to see more people in housing, in primary residence, and home ownership. This is where maybe you're crossing the line and getting a little bit fuzzy politically, because now whatever administration's in office, if you make it more advantageous for a first-time homebuyer to buy a property, and they do, they're going to claim that as a political win.
Yes.
So maybe that's where the line can get fuzzy, but they are not hitting high FICO people. They're giving them less of incentive. They're not crediting low FICO people. They're just giving them less of a negative hit. So in my opinion, it's a combination of a bunch of things. I don't believe in black and white. I believe that everything is a mixed bag. There's gray areas. There's things that are going on behind the scenes that you and I don't even know about. We don't know how this is going to play out, but we have an opinion on how it's going to play out, which I do think we agree on, because you're entering, there's more risk being entered into the market. So with that being said, I don't think it's political. I think it's meant to drive inflation down, to make sure prices don't increase. I think it's also an opportunity for FHFA to get more people into home ownership. I don't think home ownership's a bad thing. However it's achieved, as long as it's not given away for free, if you're taking advantage of the situation and you get into a primary residence, make your payments on time, do what you have to do, whatever you have to do. If you have to go pick up the second child, make sure those payments, don't fall behind, don't get foreclosed on, because you'll ruin the opportunity for everyone else in the long term. But I think the number one way to rise people out of poverty in this country is through homeownership.
Yeah. I mean, look, I agree with that. I mean, it's the reason that we're both in this is because we believe in homeownership. We believe in, that you can build wealth, generational wealth through real estate. And I'm going to say something. I'm going to make a bold statement right now that I do not believe. So these loan level pricing adjustments only impact conventional loans. That's Fannie Mae, Freddie Mac conventional loans. Mm-hmm. They do not apply to FHA loans. I do not believe that these changes are putting more people in the houses. They're saying that. They're saying, hey, we're going to help first-time home buyers. We're going to help people with, maybe like some lower credit scores, because the adjustments are going towards them and benefiting them. But we just had a meeting with one of our technology partners discussing how in this current market, people don't have the money. People are looking at the 3.5% down payments. They don't have the excess money in the bank like they used to. People are looking at it saying, I want a lower payment. Guess what? FHA right now has lower interest rates with lower mortgage insurance based off of change from a few months ago, which means a lower payment for them, even after these changes. Right now, it is not. FHA is what is putting more people into homes. It is what is giving that benefit. This balance that they're doing with these loan level pricing adjustments is not a balance. It is essentially just an additional cost to those who were well qualified, who have spent years making sure that they have their credit where they need to, that have saved up because they want to do the whole Dave Ramsey 20% down, the 15-year term. They want to wait until that point. They are now getting penalized. It is costing them more to buy their interest rate when they buy their home. And to me, that's not a good change.
So I hear you, but it's not actually costing them. They just have less incentive.
True, but it's costing them more compared to if they did not, prior to this change.
Yes.
If they did not adjust the loan level pricing
They
adjustments.
shouldn't have waited so long. They should have came to us. We would have figured something out.
Right.
No, but
and that's my thing is they had it figured out with the first time home buyers. They made the adjustment, the 30 bips, depending on exactly what your loan amount, but it's going to be around $100 a month saved on an FHA payment. That is massive.
between 50, 70 to $100. But
Right.
But here's the deal. That is a big deal. That is getting more people into homeownership. So you're saying that what they're doing isn't going to increase homeownership on Fannie Freddie?
No, I don't believe it will.
I agree. I think it will increase more first-time home buyers, though, because of the publicity it's getting. And they'll come to a lender like us, and we'll put them into a situation that's the most advantageous to them, which benefits them the most, as a good mortgage advisor should,
Yes.
unlike those retail banks, credit unions, and retail mortgage lenders. We're actually going to put you into a good situation and give you multiple options, right? But we'll put them into a good situation, and it's going to most likely be FHA. Maybe even a down payment assistance program,
Right.
but it's going to be what? Most likely FHA.
Right.
Because guess what? You still have to have approved findings on Fannie and Freddie. And if you have a low credit score,
Exactly.
you have a less of a chance to get approved findings. So now you have people like us on this podcast discussing this ad nauseum, and it's not going to push people into conventional where the LLPA adjustments are really at, right? It's pushing them into FHA where they got a 30 basis point increase or decrease on the cost of their mortgage insurance. So,
like, I mean,
I'm going to counter you and say, I hear you. You're angry. And that's how I can tell you have an 800 plus credit score.
I don't, but it's
listen, let me finish. You're angry. I get it. You feel like it's hurting people who are doing the right thing. I get it. And it is. And it's not pushing more people into conventional, but what it is doing is it's getting people talking about it. So guess what? More people who probably need the help, who probably need the kick in the butt to go out and buy a home, they're seeing it on the news, they're hearing people talk about it, and now they're like, I'm going to buy a house. That's how we raise the poverty level in America. Now, do I agree with how they're going about it? No. I think it's a cheap way of going about it. I think we need to preach financial literacy. I think we need to go into the communities that they're trying to affect, because what you're doing is now you're hurting people who have done the right things their entire life from a financial literacy standpoint, and it is hurting them, and it's not even getting more people into conventional. All it did was create headlines. It's a marketing ploy.
Right.
No publicity is bad publicity, right? So it's a marketing ploy to push more people who are in the lower socioeconomic communities into home ownership by saying, oh, we're going to do that. And they're taking it as a credit. So it's almost a bad marketing ploy in a sense, right? So they're taking it as almost like they're getting a credit, and they're not. They're still getting a hit. And I've even had people, why is interest rate still high? Well, interest rates are high right now. And like, you're not, what about the credit? It's not a credit. It's just less of a negative hit. And nobody's really explaining to them that piece of it. We are as mortgage advisors. But I do believe that it's going to get more people who need to be in homes to raise their socioeconomic status in this country into homes. I do believe that. But I do believe it's at the expense of the person who has the 20% down payment, 750 FICO.
Right.